Welcome to today's episode of Tax Matters. My name is Paras Christiana. We have a guest with us today. He's the Deputy Director, Large Tax Office, Oil and Gas Upstream, Mr. Ogunje Mulisi. Welcome to Tax Matters, sir.
Good evening and welcome.
We used to have just Large Tax Office, Oil and Gas, but recently we now have Upstream, Downstream and Servicing. What gave rise to the reorganization and when did this take off?
The organization started as far back as 2000. As part of the evolving of the organization, that's what gave birth to the breaking down of LTO, oil and gas, into various units so that we can have focus to deal with taxpayers according to segmentation. Now we have the upstream, we have the servicing, and we have the downstreams in the FRS, just with a view to giving us attention to specific taxpayers by each of these offices.
Okay, sir. Now, what would you say the outcome or dividend of the reorganization has been?
Yeah, definitely it has given us some kind of specialization within the staffs, and even in the attendant delivery of good service, quality service to the taxpayers. We now train our officers to specifically handle special taxpayers in view of the upstream now. The upstream, we know that officers in upstream are majorly working on the upstream companies without having any downstream that they can work on. So that one built up some kind of specialization, and even professionalism has been brought into the system. The regulation has been increasing as it has started. It started in April last year, and by April this year, it shall be 1 year. And we have seen a lot of improvement here.
Okay, that's very good. For the taxpayer out there, what do you mean by upstream?
Upstream is just another sector of the oil and gas. You know, oil and gas industry is segmented into upstream and downstream specifically. The upstreams are those companies that are involved in the exploration and production of crude oil. And they are majorly companies that have oil prospecting licenses and oil mining licenses, or companies that are engaged, they are having one business arrangement with another company to produce and to explore and produce crude oil. So it's majorly companies that are in that sector. They explore for crude and produce and sell. Then we have the marginal feed operators. Those are the small players in the industries. Those that have smaller fields. You know, we have fields as where you are producing the deposits of crude. It's categorized. We have prolific, bigger fields, and you have smaller players. So their production is less than 5,000 barrels per day. While the other one, you can be having like 200,000 barrels per day. Those are the big ones. So we have the major. Then we have the indigenous oil companies, Nigerians that have ventured into the production of crude oil. So those ones too are there. There are some that have not even started producing, but they have started exploring and development of their fields. Such also they file their returns with us. They are, because the regime, we have two types of regimes in upstream. You have SITA and you have PPT. Yes. SITA are companies that are yet to commence production of crude. They are under SITA regime. While those that have commenced production and sales of crude, they have been under PPTA.
So that is how they pay, because that was supposed to be my next question. Under what regime do they pay their taxes? Yeah. So already, but can you just explain properly? So for those that are yet to, they pay under PPTA.
Yeah, those that are yet to commence production of crude, because it says box sales of crude oil under continuous production is what graduates a company to be administered under petroleum profit tax. Profit tax is a tax levied on the profit accruing from the sales of crude, production and sales of crude. While The company, the CIT, those ones that are yet to enter into production, but they've started exploring and development. They've started incurring costs with a view to getting crude. They are still under company contract regime. So also those that are even producing, but they are producing gas. They are what they call associated gas. Because of the incentives that government gives to the production, we are subjecting their income on gas under CITA, under Companies Income Tax Act.
Okay, because you feel that they haven't gotten to that.
Then there are other categories of operators that are risk service. Call them risk service contracts. Those ones, they are into exploration and production, but they are just contractors to the concessionaire, to the owner of the field, the oil block. So they are taxing them under Companies Income Tax Act because they are being rewarded by payment of fees. So they are subject to tax under Companies Income Tax.
Now, in your sector, we have heard of so many terms: JV, we've heard of PSC, we've heard of MOU, we've heard of sole risk, we've heard of royalty oil, tax oil, and profit oil.
JV is nothing but joint venture. And joint ventures is just a relationship between two parties where they pool their resources together to explore a particular field with a view to bringing out oil. And in most cases in Nigeria, government through NNPC have arrangement with oil companies under JV that government brings its own funding and the IOC brings its own funding. They both own the field jointly, they fund it together. And whatever comes out of it is shared jointly among them. And each of them, of the parties, at times may be government and one company, may be government and 2 or 3 companies, each companies are expected to file their returns separately with FIRS.
That JV, how does the government come there? Do they solicit for government help or?
No, they have a concession. There is a concession that they own, and government believe that I need to participate in this field with a view to developing, as part of transfer of technology to Nigerians, and for government to have a bite of the crude, and whatever. And most of the joint venture government owns 60% equity, while the IOC owns only 40%, except for one, that's of Shell JV, where government owns 55%. And the IOCs, there are 3 other IOCs there. We have Total, you have NAOC, and you have Shell. The 3 of them have 35% equity. So each party will bring its own equity cost, funded through cash calls, and whatever comes out of the share. But each of the agencies, each of the IOC will now file its returns with FRS separately. And that we tax them separately, but under the production sharing contract. Production sharing contract is being administered through another act in conjunction with PPTA. That I will call it Deep Offshore Inland Basin and Production Sharing Contract Act. That one is specifically for companies that are operating beyond 200 meters water depth. It's majorly for deep offshore. Those are the companies that are deep under the water. Some are operating even beyond 1,000 meters water depth. So they have some kind of incentives that the government gives to them because of the difficulties or the high cost of exploring from the deep water. And they file their returns because government owns the concession. Government is the owner of the concession. It just brings the IOC there as a contractor. And under it, the IOCs, the international oil companies, so to say, they fund the operation there 100%. They carry the risk. And government will only come in when they succeed in the firing of the crude oil. So, and they now have a terms on how they are going to share it. But to share it, before they share it, government must first of all take a bite from it. And that one is from royalty. They call it royalty oil.
Okay, so that's where the
royalty oil. They must pay royalty, but in payment of royalty, which is done in kind, it is done, they call it royalty oil. That is from whatever oil that is produced from the field, you take first of all take royalty oil out. Then you allow the company to take its own cost also because it had incurred cost. So it takes its own cost in kind, which is through cost oil. And if there's any tax that is computed and is payable, it's also paid in kind. I call it tax oil.
Wow.
And whatever that is left is profit oil, which is to be shared between the owner of the concession, usually the government, and the oil companies. Then when you look at the sole risk, these are mostly indigenous companies. Okay. A concession that is only owned by someone and it carries the risk alone. It's not sharing the risk with anybody. That's why you call it sole risk company. They also file their returns based on what they produce. MOU is more of memorandum of understanding, which is an arrangement between government and the oil companies. It came at a time when there was depression in the international oil market, when the crude oil price was maybe going as low as below $9 or a little bit above $9. And government was finding it very difficult to sell its crude, as I think started around 1986, thereabout. And government had to come to some kind of arrangement with the oil company to give them incentives, to encourage them to continue to explore and to produce, and to help government to market its crude. So we call it memorandum of understanding. There are some incentives that have impact on the PPTA. Because of that MOU, PPTA is set aside in some cases. In determination of the pricing, for instance, in determination the other they call it MOU credit that is given to them with a view to just encouraging them to continue to produce because of the depression in the oil market. The agreement says that the companies are to pay the lower of government take and revised government take. And when the government take, when the prices of the crude oil exceeds $39, the government take now becomes lower than revised government take. But before that position, revised government take was lower than government take. Okay. And the revised government take is the incentive granted to the IOCs.
So I want to just go back to the royalty oil and the tax oil. Now, you said the royalty oil is the one that they give to government in kind.
Yeah, the royalty. Government has the resource. Mm-hmm. And whatever you produce, say you must pay me my royalty. Mm-hmm. Though you are the operator, you funded it, but if the thing were not to be there, you will not bring out anything. You will not even put your money down. It's because you know that it's there before you put your money down. So whatever you produce, I take royalty. That royalty, instead of paying me in cash, I will take it in kind. It's royalty payable in kind.
Okay. And then for the tax oil, that's the one they also give to themselves.
No, the tax oil is computed on the contract area. Mm-hmm. The contract area is just the field, the oil block where the production is taking place. Okay. And for PSCs, the Deep Offshore Land Basin Production Sharing Contract Act specifically provided that assessable profit will be ascertained for each contract area. So it's always running fenced. You don't bring other costs into it. And it's owned by NNPC. But aside from that, we have others that we call PSA, Production Sharing Agreement, but it's just a nomenclature of status. That is where it's not government, it's not NNPC that is the owner of the concession. It is an individual or another party. We call it, the law regarded them as the holder. It said the corporation or the holder. When you see the holder, it's saying that it's not government in this case, it's an individual. And we have cases like that are in operation. We have the issue of Fanfa fields. We have the Agbami field, that's Star Deep. Star Deep and Fanfa. Okay. We have the Sapetro and Tunip, Total Upstream, and others. So we have such.
Okay. Well, finally, in recent times, we've been hearing about the PIB, the Petroleum Industry Bill. Yeah. Now, how does this bill, or how is this bill going to affect the mandate of FRS in collecting oil and gas in the country?
The bill is not of recent time. It had been with us since 2000, starting from 2006 or thereabout. We have been on and on it. And if you look at the PPTA, it had been there for a long time. Okay. But the PIB, it looks at about 16 different bills, different laws want to consolidate under one, of which fiscal terms, the tax law, PPT, is part of it. So the fiscal law, the fiscal aspect of the PIB is related to taxation of petroleum industry, okay, which we will no longer be called PPT when the bill is passed to act. It's going to be called Nigerian hydrocarbon tax. Hydrocarbon tax. And in that regime, it is making oil companies, people that are operating in the upstream sector, to first of all be subject to companies' income tax. Wow. So it's going to have a company's income tax which will cut across all the sector of the economies. Either you are oil producer or none, you are supposed to be subject to companies' income tax first. Then the Nigeria hydrocarbon tax will just be a resource tax. It's only be given to be payable by you if you are producing crude oil, bitumen or condensate. So that's number one. It's going to change the present taxation of oil and gas, I mean upstream sectors of the economy. Then another impact is that it's giving some kind of incentives, different from the one that we are given now. Presently, we are giving some kind of incentives on capital, that we call it PIA, ITC, or ITA. PIA is just petroleum investment allowance, ITC investment tax credit, and ITA investment tax allowance. Is given as an instant allowance to the companies on the cost of capital employed in the production of crude oil. When the PIB is passed, that one will change to production allowance. So it's now going to be based on what you produce from the field. That will now give some kind of incentives based on your production. It makes administration of it easier for FRS and avoids tax planning schemes. Okay. So it's going to have a very positive impact in the administration of petroleum income, and also increase the revenue of government, and also the rate of tax is going to be a little bit altered. The one under JV will be a little bit reduced from what it is presently at 85% to 80%, and that 80 will be 30% companies income tax and 50% NHT, Nigeria hydrocarbon tax. The deep offshore that presently taxed at 50% will be subject to company income tax at 30%, 25%, and a Nigeria hydrocarbon tax. So that one a little bit increased from 50 to 55, while that one is brought from 85 to 80. And the PSCs now under the PIB, if it is passed, the contractor will now have the ability to file their returns direct to FRA rather than going through NNPC to file. Under the PIB also, if it is passed, the company under the PS now will be able to consolidate their cost and revenue from all the fees to file with FRS.
Okay. Thank you very much, sir, for your time.
Thank you. Okay, my sister.
Okay, don't come. Tax man, now you. Sit down. How long you thought so you go take bring the tax clearance certificate for me?
Oga, once you give me the money, the tax clearance certificate go ready now.
Now?
Yes, Oga.
Oga, wait, make I bring the money.
Wait. Agent for Federal Inland Revenue Service? This one a Wururu person. Go for here. Guy, forget all these Wururu people. Go any Federal Inland Revenue Service office where they near you. Go collect the original tax clearance certificate. To know the original tax clearance certificate, the tax certificate must get FIRS watermark. It go get signature on top of the FIRS seal, and the name of the tax office where they on top of the certificate must they correct. No print, no give, no even collect fake tax clearance certificate. FIRS don't want say anybody we then catch with fake tax clearance certificate, now jail straight.
For more information, visit www.firs.gov.ng or any FIRS office close to you. FIRS, it pays to pay your tax.
Welcome back. You are still watching Tax Matters, and on this segment, we have yet another oil and gas taxation guru in the person of Mr. David D. Ogedengbe, Deputy Director, Tax Controller in charge of the Large Tax Office, Oil and Gas, downstream at the FIRS. Remember, we are talking about 3 subdivisions: upstream, downstream, and servicing. Mr. Ogedengbe, welcome to Tax Matters.
Thank you very much.
Yeah. Prior to the reorganization, we knew of just Large Tax Office, Oil and Gas. Now you have Large Tax Office, Oil and Gas, servicing, downstream, upstream. You are in charge of downstream. What does that mean?
Well, just like you rightly said, as a result of reorganization in FRS, we now have the Oil and Gas Office, erstwhile now broken into 3: upstream, downstream, and servicing. Now, The servicing is that segment or that office that is in charge of servicing companies. And the downstream is involved with companies that are engaged in the downstream sectors of the economy, which particularly include petrochemicals, refineries, and oil marketing, both for oil and gas.
Under what tax law do they pay their taxes?
The oil and gas downstream companies pay their taxes under the Company Income Tax Act.
Why is that? Why don't they pay under PPT?
Yes, this is because they are not engaged in production and exploration. Only companies that are engaged in production and exploration pay tax under the Petroleum Profit Tax Act, PPT. But other companies that are engaged in downstream pay their taxes in accordance with the Company Income Tax Act.
Okay. Now, what has that reorganization meant for those companies that you deal with? How has it impacted on your relationship and tax collection?
On our own side as FRS, it has helped us to be more focused. Not only that, it has helped us to specialize, because we now know that we are dealing with a particular segment of the oil and gas industry. So that helps us to take their issues head on and helps us particularly to be focused in looking at their activities as a whole, and then be able to ensure that each of the companies in the subgroup, that is the downstream, are evaluated using the same parameters.
Okay. Why don't those companies simply be let off? I mean, why do you have to have them under oil and gas if they don't pay petroleum profit tax?
No, these companies are still engaged in oil and gas activities. Okay. It's just that they are engaged in another segment of the oil and gas. Okay. Mind you, the upstream is involved in production and exploration of crude oil. After the crude is produced, it has to be processed. After the processing, it has to be marketed. That is where the downstream comes in. Okay. We are engaged with companies that are processing the crude. Mm-hmm. We are also engaged with companies that are marketing the crude that is processed. And when we said process, we mean that the crude is processed into such products as PMS, which we know commonly as petrol, diesel, kerosene, and all the other components, Jet A1, aviation fuel. All those are various components of the processing that comes from the crude produced.
The bottom line, like you accountants will say, is collection. Yes. Have you been able to collect more since this segmentation, this reorganization took effect?
Yes. Since this reorganization took effect, which was from last year, the collection from this particular segment has increased tremendously because it has helped us to be focused. Not only that, we were able to engage in a sector audit of these industries, and last year alone we were able to audit about 82 companies, which would not have happened if it was just under the umbrella of oil and gas as it was.
Okay. In recent time, there has been talk about the petroleum industry bill. In fact, it goes way back. I mean, the Petroleum Profit Tax Amendment Bill was submitted in 2005, and later on it was kind of withdrawn. The proposed amendments have now been collapsed into the Petroleum Industry Bill, and it seems things are moving now at the National Assembly. How will that Petroleum Industry Bill, PIB for short, affect the downstream sector?
Well, the Petroleum Industry Bill is a multifaceted bill, and it will affect all the various segments of the industry, upstream, downstream, and servicing. But particularly for the downstream, the Petroleum Industry Bill is going to create a new fiscal regime that is going to particularly address some of the challenges that we have faced in the time past. That is under the company income tax and the petroleum profit tax. Some companies that were not sure whether to pay petroleum profit tax or company income tax, we now have a clear responsibility to pay company income tax. So to that extent, it's going to dovetail to increase revenue even for the downstream.
On that note, we want to say thank you for coming on to the program. We hope that when next we call on you, you will oblige us with your presence. Well, viewers, I want to thank you most sincerely for watching. Let's do this again next week on the same station, same day of the week, same time of the day. Bye for now.